Hi guys, this is Terry with Futures IO. It is my honor to welcome back Corey Rosenbloom for today's webinar, Tips, Tactics, and Real Trades, Trading Intraday Trend Reversals. Today, Corey will detail his experiences in recent intraday trades in leading stocks, ETFs, and especially index futures. Now, during the webinar, if you have a question, you can type them into the questions box, and we'll do our best to answer them at the end of the event. Also, if you're watching this on YouTube, please do us a big favor and give us a thumbs up if you enjoyed the webinar. And as always, please feel free to share, comment, subscribe to our channel. It really helps us a lot. Please don't forget that you can now follow us on Twitter and Facebook at FuturesIO. And without further delay, I'll hand it over to Corey.
All right, here we go. Make sure we can share my screen. We can see everything okay? There we go. Okay, once. There we are. Okay, perfect. I can't see the chat box. If there's a chat that comes in, I can't see, or the questions box, I don't see that.
I'll handle all the questions.
Okay, perfect. All right. Well, Terry, thank you so much, everybody, for attending this session. This is exciting. This is what a lot of I do in my trading. So I'll, in an hour, break down in detail as much as possible with respect to intraday tactics. We're looking at how I set up the trading day. We're going to look at two things, which is the bigger picture, how to, I hate to use the word forecast, but how to and predict, those sort of words are kind of dirty words, but how to anticipate what the market is doing in terms of supply demand. That's all we're doing. We're not making a crystal ball projection. We're looking at the probabilities, looking at the data, looking at the facts, and trying to piece it all together to determine whether the next session or the remainder of today's session will be bullish, bearish, or neutral, and therefore how do we take part. We're going to look at indicators, going to look at methods, tactics, trades, all of that. So Terry had a good job of setting us up. So let's go ahead and jump on in here. And as you probably know, there's no such thing that can get you a perfect trading outcome every single time. I wish there were. I've looked for it. I've been 15 years at this, all kinds of conferences, webinars that I've taken as when I was learning the craft, and now I've been teaching since 2009, and I haven't found anything. If anybody has, let me know. But all we're doing is putting the odds and probability in our favor, and once we have an edge, which is just a greater likelihood of one outcome occurring over another, and we're going to risk our capital using a stop loss, that if we're wrong, we're going to be able to limit our losers or limit our loss and maximize our gains. That's all we're doing. So everything we do in trading and this presentation and your trading performances, we're just looking to put the odds in our favor, make an educated determination, which is going to be our trade, and then limit loss and go for those targets when they work. So that's what we're doing. And of course, all trades do involve risk. So I got started. If you're new to my style of trading or my style of method, what I do, I've done everything except Forex in my 15, 16 years now. Started as a Warren Buffett style longer term fundamental analyst, 1999, I was back in high school then, and that worked well into the bear market, 2001-2, and that made me a technical trader, looking at technical analysis, the charts, how to formulate, well, how to figure out where the bear markets are, and how not just to lose money on the down market, how to protect our capital and find opportunities. So technical analysis was a natural outgrowth of that, and I was really involved in technical communities from 2003 until 7, just kind of as a hobbyist and interested person, but I became professional after graduate school in 2006 into 7. That's when I began working on my CMT, Charter Market Technician, which is everything you have to know, everything you think you possibly know about trading and technical analysis in the market, you gotta know. And there's multiple textbooks that teach you. So there's a couple ways to learn how to trade. It's going to be on your own experience, making mistakes and making progress on your own, or with a mentor, or of course with formal education. So there's not a lot of major formal. There's not really a grad school program or PhD program in trading. We have to do that with our own accounts, with our own experiences, and I think the communities are important. The Big Mike, Futures ISO, everything you do together as a community, just that helps progress each one more. We learn lessons, we talk about what's working, what's not, and we make each other better in this game. And it's such a cooperative game. It's not really reason to be competitive. Just trying to figure out where the markets are going, where the supply-demand relationship is, and of course, who's in control, bulls, bears, buyers, sellers, and our goal depending whatever method we choose, whatever market time frame, is to align ourselves with, in my experience, the trend. And we'll be pinpointing when trends start, when they end, and how to engage them along the way. I've been in Los Angeles here 3 years, moved from Alabama. You'll probably detect a little bit of a southern accent, but hopefully that's fine. And this is my 2-book contribution to the trading community. It helped me enough just to write these and formulate the plans and strategies, so it's made me a much better trader, as does the blog and all the things that I do with the trading community. I've been so fortunate to be able to work with some of the great traders and great educators in the business in 2004 to now. And it's my pleasure, honor, and distinct privilege to be able to give back. And of course, in the process, hopefully, when you teach these things, it makes you learn them more. So, and of course, going out and giving the examples and finding, try to make them not textbook. We don't want to look at a textbook environment where the examples are. So I'm trying to use, in the trades that I've taken, trades that I'll be showing you, and how these things set up and play out, I've tried to make it not perfect. And so bear with me as we do that, but trading is not a perfect game. And I'll keep coming back to that, as you all probably know. It's real world, it's probabilities, there are no certainties. So with that in mind, I'm going to keep it simple. Simplicity. I've, again, done the CMT for 2 years, and kind of personal record, it hurt my trading. My trading performance as a swing and intraday trader suffered as I learned immense levels of information. Elliott, Fibonacci, all these indicators, all the things you can think about, point and figure charts, et cetera, patterns. It was great. It was fun. I loved all of it. I have no problem with it all. But when you all do it at once and you just focus on education and it kind of drift away from the real world of the market, and I guess you kind of find perfection, you don't. So in my 15-year swing trading, investing swing trading, now day trading from 2007 to present, I would advocate, no matter what level of a trader you are, to focus on simplicity. And so we'll talk about these little reversals today. So the focus of today's presentation is on reversals, but just keep in mind that there are 3 groups of trades: simplicity, retracements are pullbacks in an uptrending or downtrending market or environment, or breakouts are when you have this range compression and the market trades sideways. We might call these rectangles or triangles or wedges, and you can play the break from these levels, but those are for another day, another session. This is talking about reversals. So a lot of traders that are new are drawn to reversals. I would argue that it's almost a siren call, that it's fun to call that top and look at that, it's a doji, a wave 5, and all the factors that go into a reversal. And you get in there and short it, and you're on your way to $1 million. But in the real world, markets tend to trend more than reverse. So as we'll see shortly, we'll jump ahead a little bit. We'll go back. But when you first start your CMT material or any kind of formal education, typically you'll come across Martin Preen. And he wrote all sort of wonderful books, Technical Analysis Explained being one of them. And the first really paragraph of the first chapter, the first book you have to read, it stuck out with me, and it still does. It's shaped my trading and has made me a much better trader, keeping away from the complexities and going back to simplicity. But technical analysis and trading is just this. It's the art. It's not a science. It's an art of identifying a trend reversal at the earliest stage and then trade in the direction of that trend until, here's the other part, the weight of the evidence proves the trend has reversed. So 2 factors we could build a model, which is earliest stage and weight of the evidence. Weight of the evidence does not mean a proposed 5-wave Elliott count. It does not mean a singular doji or shooting star or hammer reversal candle or even a divergence, which I'm very fond of. You're going to put the weight together, put the puzzle pieces, put the probabilities, and make an educated decision, and then limit your risk if the market keeps trending, which typically it does. So again, in a trend that keeps going, you're going to have multiple points of continuity, only 1 point of reversal. So if you want to be more accurate, if you're doing trading, go with the trend, because you're going to, even if you're wrong a little bit on timing, if that trend continues and you buy an uptrend, even at a swing high, it pulls back. If it goes and make higher highs, you're going to be with a trend, but you've got to be right. Your accuracy must be really key when you trade reversals. So we're not going to get the top, not going to get the bottom. We're going to use the weight of the evidence and earliest stage, and that never, ever, ever, ever is going to include the absolute peak high or peak low. That's just impossible. So we look at 3 trades, just going back to simplicity: retracement, reversal, breakout. And if you are an intraday trader, we're going to look at really 2 type of day structure. This goes back to market profile, Stottlemyre, Jim Dalton, etc. But it's just how to frame or structure your trading day and how the market behaves in terms of bull, bear, supply, demand. So starting at the top, range day is going to be a balance, equilibrium. Nobody's in charge, nobody's winning. The market rallies to a high, falls to a low, rallies to a high, and that's what's going to create our patterns, which is our rectangles, triangles, etc. The exact opposite is going to be a trend day, when the market typically gaps, going to gap up in this case, in this example, going to pull back, trade higher, pull back, trade higher, might see strong internals, might see strong momentum and strong volume. And the market just does a trend day from the start to the finish, not a range day. And indicators that work well, like Bollinger Bands, on a range day are not going to work on a trend day. So we'll talk about that later. But again, we're going to focus our attention on this, rounded reversals, intraday reversals, which is basically what I also call a failed trend day. So if you structure the market, structure your S&P futures or your Dow or E-minis, whatever you're looking at, NASDAQ or the Russell, or gold, or oil, or Netflix, or Apple, etc., you're going to quantify them by a range or flat or sideways session, trend session, or a reversed trend session. So keeping it simple. And just really quick, just kind of putting it back into terms, I have a whole presentation on this, but it's basically looking at, to determine what the day structure is going to be, look at the pre-market action, which is before you wake up, so Asia and Europe, what's going on over there. Of course, the futures, what's happening the hour before the market opens in the Dow and the NASDAQ and the E-mini, S&P. What happens at the open? Is there a gap or not? And the first hour, which is, if we go back to our diagram, this is how you would do it. So range day, nothing out of the ordinary. First hour, of course, no gap. First hour, nothing, forms a range. And the morning session, still nothing. Trend day, going to have some interesting overnight action. Market's going to open with a gap. First hour keeps on going up. Doesn't fill the gap. And you're going to have characteristics of that on a rounded reversal day. Looks like a trend day, but it's going to fail. You're going to have divergences. Going to have some sell patterns and other points of view that I'm now excited to talk about. So all that's the foundation. So we'll jump into that. And if you have any questions, of course, I'll let Terry know in the questions, and I will jump to those if it's a major question. Otherwise, we'll kind of jump through and get them all at the end. But I like to make it interactive. I, of course, enjoy in-person presentations and going and doing that. Webinars are fun, but I want to make them as interactive as possible. So if you do have questions, please let me know if I'm going too fast or going too slow, and all those factors too. All right. So the other factor of not just what trades to take, as you might expect, on a range day, fade trades, or you would have short sell trades at the upper resistance, maybe the upper Bollinger, buy trades at the lower Bollinger, lower support. That's going to be kind of a call it ping pong, buy the low, short the high. It's fade type strategy, more reversal style strategy. A trend day is going to be a more retracement strategy, retracements, and watching out for those reversals. So we're going to talk about the indicators to emphasize, or to emphasize, emphasis to put emphasis, on which to put emphasis, or to ignore. And working with traders as a coach, as working on a blog and doing the member reports that I do, honestly, when I work one-on-one with traders, and goodness, I've been there too, we want to find these indicators, and I see a lot of people fail because they'll take an indicator, RSI, MACD, even Bollinger's, and they'll try to put it in every single market environment. So there's no differentiation. There's no change. There's no difference in range or trend environment. So we'll talk about how that's not the best strategy and how that can get in the way. So just kind of cluing you in. Moving averages, if you like using those, are going to be really, really good on a trend day. So just buy the pullback to your moving average. Typically works out like a bull flag or etc. Market's going to chop up and down through them on a range day. So, and it's not just the indicators for which to put emphasis. It's the trades to take or avoid. Got the Martin Preen quote. So if you're new to technical analysis, I'm assuming you're not, but if you're new, if you're kind of starting out, first few months as a trader, the first thing you want to look at and discuss is, or view on a chart, is what's called structure. And structure is just nothing more than pushing or counting the highs and lows. So an uptrend, by definition, is going to be comprised of higher high, higher low, higher high, higher low, and there's no indicators necessary, no training wheels, nothing special, just look at the highs and lows. That's what's going to define a trend is up or down. Lower low, lower high, lower low, lower high, so on and so forth. Call this price structure. Of course, a trend's going to be reversed when it starts going from low to high, low to high, low to high, whoop, higher high, higher low, take it out. So the moment a price reverses from down to up, it's going to be high high, low low, or high low, and then take it out. Not the first lower low, not the first lower high. If you are, again, new, if you don't use moving averages, I highly recommend them. They're not the best indicator, but especially in a range environment, but they help you quantify structure. They kind of give you this is a training, sort of a training wheel. You can look at the price itself, highs and lows, quantify them. Or in a trending environment, use averages. And it's just basically where the price was, where it is now, and it puts that into an average. That's a line on the chart. That's what we're seeing here. Since 2003, I stumbled across the 2050, and that's what I've been using ever since. These numbers are not special. You can use 21, 55, if that's more Fibonacci-ish. I've just found this to be a short-term average and an intermediate-term average. So in the charts you'll see it's going to be a 20-period exponential, going to be green, and a 50-period exponential, that's going to be blue. And if you are a swing trader, I'm going to put on that 200-day simple average. We'll see lots of examples of this. So we call the MAO, moving average orientation. When the 20 is under the 50, that green short term is under the intermediate, it's going to be a downtrend. Simple, but that's how we quantify it. If it's the 20 short term above the 50, that's going to be a bullish trend, and when they are flat, they're chopping up and down, that's a range, and there isn't a trend. Here's an example. So again, downtrend 2050, green going down, and we have the EMA's cross. This is called a bullish crossover. It's the same point that the market goes higher high, higher low, higher high. And of course, what you want to do in this environment are these yellow highlights. We'll talk about these three. It's buy pullbacks to a rising moving average in an uptrend. Vice versa. Short sell retracements or flags toward a falling 20-period moving average in a downtrend. I know that's super, super simple, but believe me, this is more effective than a lot of major counting waves, doing Fibonacci projections and doing all sorts of indicators. If you're new, start with this, build from this. If it's working, keep it at this. But if it is a trending environment, buy the pullbacks. And so that's what we're gonna formulate that later in the presentation. But just picture if we were talking about retracement trading tactics, that will be what we're doing. Take it one step further, and we're going to be talking about reversals. So again, in the context of this presentation, the next 40 minutes with you here, we're going to look at how a market reverses. And when it reverses and gives us permission to start trading in another direction, then we just play retracements. But just keep that in mind. We're going to focus on this, on the reversals themselves. But if you're going to be a trader, well, of course we are traders, but if you are to trade, you don't trade reversals. You trade pullbacks in a new uptrend and a new downtrend. A couple of examples. We'll call these phase shifts. This is our ES futures going back to September. A little bit of a range, jumps down, falling EMAs. There's a little bit of a retracement down, higher high, higher low, take it out. It's in September 15. EMA's cross, buy that pullback, up it goes. Next session's going to go down, break under. EMAs are going to cross, lower low, lower high, take it out. And you're going to short that one. And so I like to, when I'm working with members, or especially working brand new, with a brand new trader, it actually does help, especially when doing examples, to color code these. And it's not at all pedantic. It's important to get the distinction between these phases. That when a market is falling, lower lows, lower highs, and the EMAs are separate and downtrending, that's a red environment. You want to short sell pullbacks. When the market goes above the averages cross, and you start to reverse higher high, higher low, take it out, higher high, higher low, etc. That's a green environment, and you want to be a bull or a buyer, typically on pullbacks. And of course the opposite is true. So if you're new, just think about color coding. That if this is an uptrending environment, focus on moving averages, buy the pullbacks. Now, if we want to make this official, strategize and make it a system, make it into somewhat of a method, you would have this. If you're going to program this, or just writing out in your trading journal, trading plan, making it codified, making it official. A trend is not reversed until the 2050 EMAs cross themselves and price rises above a new higher high. So this is the same little model we had otherwise. It's going to be a push above, EMAs are going to cross, first higher high, not a trend reversal, first higher low, not a trend reversal, also not a buy signal unless you're really aggressive, because this trend could keep going down. Could be a false signal, or could just be developing a range. We want it to go ahead, make a higher high, make a higher low, cross the EMAs, then take out the higher high. That's a trend reversal. At that point, you want to be a buyer. So what leaps off this chart for me are going to be these two little pullbacks. Not this, and not this. I know. How great would it be to have jumped in here? Be wonderful. But how do you know that this is not any different than that, to that, to that, to that, to that? So what jumps off the chart at me as a professional trader isn't any of this. It's these two factors right here. They're the pullbacks that occur after a trend has been officially, using the weight of the evidence model, Martin Pring again, reversed. And just in terms of simplicity, it's higher high, higher low, EMA cross, take it out, buy the pullbacks. And we call this a T-Rev. It's a trade you can take. Again, if you're going to be swing trading, it's more a swing trader play. You can actually buy the break. But I put a stop under this, a tight stop. If you're playing for a longer position, swing trading, you would actually use a wider stop under the low. Because the market can come and retest here, but it cannot, by definition, break under and continue the uptrend. So it's basically, this is as close to the edge as you can get of a official trend reversal. That can be just a longer term, we call it a core position. Otherwise, as an intraday trader, this is my attention is going to be focused on, not so much that. I do more intraday trades at this point than swing trades. But if you're a swing trader, you might want to focus on this more, or the pullbacks. So either one of those. So a couple more. This goes back to September again. This is our ES futures. And this, you can see this is a larger separation. Now, this is interesting because, first off, there was that gap. This is September 9. Big downside gap, first hour. And of course, I'm in Los Angeles, so Pacific time here. It did not fill. Didn't even try to fill. So you can make a, hate to use the word forecast, but make a prediction that odds favor continuity down. And that's ultimately what happened. Now look at what occurred. The market never really gave you a pullback to touch the average until noon, which is about an hour to the market close. Still would have been effective, but that's when the little patterns come in, flags. Short sell the flags, retracements. Next session, oh, what a difference a day can make. The market went ahead, higher high, higher low, EMAs crossed, took it out, and there's your pullback. So the only major trade would have been at 11 o'clock, at about 21.33, thereabout. Of course, you would exit on close or at these little levels here when it starts to pull back. Next session, same thing, downside gap, no fill of the gap, EMAs cross, and we really have a mirror image or repeat of the 9th. Except this time, what happened here didn't go all the way down. It had held support we'll talk about this later, divergences, and then form this U pattern or saucer pattern. Call this rounded reversal, and up the market went. Despite that, you had 2 spots to short, even 3 if you count that. So 1, 2, 3, and it's nothing more fancy than just short selling, a pullback to a falling moving average, which your stop will be above it. Now, that's the simplest part. So if you're new, please review the video and go back and study the price concept, which is higher high, higher low, take it out, or lower low, lower high, take it out for a reversal from up to down, and the moving averages. If you're comfortable with that, join me on the journey to go to the next level, which is volume, momentum. This is a factor of what we call Dow theory, or Elliott for an example. Also Wyckoff. Lots of founding thinkers and technical analysis had similar thoughts. But mainly, if a trend is in motion, there should be confirmation. Confirmation simply, if a price is rising, if a new trend, a stock is rising, rallying, and it's going up, that means more buyers and sellers, more aggressive buyers, and more enthusiasm on the buy side, and you want to see volume confirm that. So we would make a formula. If price is making higher highs, higher lows, and volume is also trending up, that's a confirmation, and that suggests that the future should be up, that trend should continue. Therefore, we want to be buyers. However, as I'm sure you're aware, no trend can last forever. Netflix can't go up forever, Google can't go up forever, Apple can't go up forever. All those stocks have had significant pullbacks, at least not recently, but last few years. And so even popular stocks do experience pullbacks, reversals, etc. So what we're going to look at for this is going to be non-confirmations. Again, Charles Dow, non-confirmation. If a price is rising, if trend is up, but volume, you can see it, is trending down, or momentum in this case is trending down, price is making higher highs, but momentum, market internals, volume are not. That's a non-confirmation, and that suggests a trend reversal, especially if you've had a lengthy trend. That's your key. The trend's been going on for a while. You're starting to see divergences. You don't want to buy those pullbacks. So just this is kind of one for, I won't go over it necessarily, but if you are making rules, and hopefully we will, but when volume and momentum rise with price, that's a confirming variable. Expect the trend to continue. That's what these C's mean. Price is making higher high, higher high, higher high. Momentum, volume, internals, etc. are also making higher highs. We expect the trend to continue. We will be buyers of pullbacks or breakouts if you are aggressive. I'm not. I like retracements and flags and pullbacks to the averages. I don't like breakouts, but if you do, this is a breakout. This is a retracement. So it's just a little bit different in terms of tactics. Now, when volume and momentum diverge, as in this red line, so price is at an absolute higher high. That's a fact. That's undeniable. This is a higher high. But momentum is not. Let's imagine that volume is not, and maybe some internals, if it's an intraday chart, are not. That's a non-confirmation. That suggests a future reversal and makes us bearish, as in do not buy this retracement. This right here did not make a higher high, so this failed, would have got you out at a loss. And then as it breaks the trend line, it does form a breakdown and reversal trade. Remember, reversals are aggressive. You typically go in trend line breaks, like a head and shoulders, for example, and retracement is typically a pullback. So a little bit different tactic, but that's just how we do the quantification. So once you have this break, trend reverse, short those pullbacks. And the most important thing is to factor in the concept. So as long as you learn the concept, which is price up, thing being volume, momentum, internals or other factors, maybe breadth, then that's a confirming variable continuity. If price up, thing not up, thing diverging, thing being momentum oscillator, which is what I use, rate of change, ROC, NYSE tick if you're intraday, NYSE breadth, or just volume. So whatever the thing that you use, it's more important you get the concept, and that is simply price up, thing up, continuity. Price up, thing down, non-confirmation, non-continuity. This makes a lot more sense when you see it on examples, by the way. So jump in this one real quick. Momentum has a leading edge on price, such that when momentum itself, or volume, or internals, jump up to a noticeable new high, that is a forecasting variable. We've already talked about it. New momentum highs forecast new price highs. And that's just not too difficult. But also the B aspect, momentum divergences precede reversals. Momentum divergences precede reversals. And a surge of momentum during an uptrend suggests trend continuity. Want to be a buyer of retracements. Same thing. Surge of momentum after a divergence signals the birth of a new trend and the reversal of an old one. And that's, we're going to codify this, but that's this little factor here. All right, so.
Hey, Corey, I have a question.
Okay, sure.
What is the 310 MACD oscillator that you have listed as your top preference?
Sure. This is from Linda Raschke, and Linda uses the 310, and it's just the difference. It's a modified MACD. The MACD, I think it is George Appel, the standard one you'll see in your charts. I think it's a 926 60, whatever the 926 8, whatever. But that's a standard MACD. We're going to make it a little bit faster, and it's a difference in the 3 and 10 period moving average. And that's going to formulate these. So it's really the same thing. I have a couple charts later, but it's very similar, if not identical, to rate of change. And just what you're looking at here, again, it's the concept, not the absolute value. It's when the oscillator makes a higher high, that's confirming, not is a divergence, but you can use rate of change. And all that is takes the current measurement, subtracts out where it was 14 bars ago, or 14 days, or 12, or 10, whatever the period that you use, and that is going to create, surprisingly, a very similar indicator. So if you don't want to do this, all you do is just take the 12.26.9 out of your standard MACD and type in 310. And that's going to give you a similar model to that. Otherwise, just type in rate of change and go from there. If you don't want to use that, you can use tick or breadth. If you're particularly an internal or an intraday trader, we would use that. So it's I don't mean to be complex with it, but there's just lots of ways to get at the principle. Lots of ways to figure out whether or not something is confirming or disconfirming a trend. So I like the 310. It's what I was trained from Linda on. So again, same thing. I learned it early and I stuck with it. So it's something that spoke to me, that I understood, was trained to use, and so I did that. But other people might have the same level of affinity to their rate of change, or an indicator just flat out called momentum, which I know it's in TradeStation, but other charting platforms may have something similar. It's just basically measuring where price is now versus where it was at some moment in the past. So we're going to jump on this really quick. It's again, what we're doing is defining a principle. We're not looking for anything special or magic. It's just a principle. And physics, the harder you throw something, the higher it travels before it reverses. Just kind of lightly tap like a pencil or a ball or something, it won't go that far. Really throw it, put the muscle into it, it's going to go straight up. Eventually it's going to fall, and momentum or acceleration will fall ahead of the actual object reversing. So this impulse reveals a large-scale shift in the supply-demand relationship. That's all we're doing. Don't focus on indicators. Just we're looking at something that shakes the balance, clearly says who's in charge. And whoever is in charge means they probably will keep possession of the ball, or whatever the analogy you want to use. So when we're talking trend reversals, which this presentation is going to focus on, we're looking at the concept of not just confirmation, non-confirmation. That's part of it. We're looking at impulse. An impulse is a major shift in the supply-demand relationship. This is one of the hardest things to teach, or to communicate. So, bear with me and sort of see it on your own charts. We'll look at other examples in a moment, but just to kind of jump through this. It's impulse. What are we looking at? Supply-demand relationship. An impulse is something big, throws the market out of balance, out of equilibrium, which is the buyers and sellers are meeting each other, which is a trading range. It's going to throw it out. It's going to put it into disequilibrium. They're hidden, and most people don't see them because this little push up off this low, if you kind of don't see this chart, this little swing here, how is that different than this or this or this? It's not really different. You got to look beneath the price. And in this case, the indicator could be tick, could be breadth. We'll see those in an example, shows a sign of strength. And for more information on this, this is Wyckoff, Richard Wyckoff. He calls it the sign of strength. I just call it the kickoff because that's the modern day equivalent, because he didn't have computers. He didn't have anything but volume. So his concept was sound, but we have such an advantage in 2016 and of course obviously beyond, because we have so many powerful computers and so many great indicators. But that doesn't matter. As long as we get the concept of impulse, supply, demand, shift, burst, start of a new trend. That's kind of what Wyckoff was talking about. So we can have so many advantages over him and his teachings from the 30s and 40s, or 20s, 30s, but here we are today. So it is a noticeable, it's off the chart. It's very, maybe not in this chart, but as we'll see them in real world, very visible, very clear, and you do have to train yourself to see it. It's not going to start happening the moment you're off the presentation. If it's a new concept, you're going to have to work with it, see it, and try it on your own. It took me a while to learn this too, but it is very, very powerful in terms of forecasting potential reversals. So don't give up if this is kind of a tough tactic or tough kind of concept to find. It's going to be best when divergences take place, and again, those are non-confirmations. We're going to go ahead and just jump into the examples. So again, Terry mentioned it too, but it's this is momentum. This is rate of change. This is not the 310. I'm just for the purpose of the presentation, showing you different ways to do this. So I use the 310 because I was trained by Linda. Momentum, same thing. ROC, same thing. It's just trying to ascertain and trying to figure out where there is a large-scale shift in the supply-demand relationship. And it could be volume. And it could be just when volume's kind of low, price is kind of low, but this thing pops up, the price pops up, and volume goes to a new high. That says there's a lot of interest. There's a lot of a shift. There's a lot of power, impulse, on the sake of the buyers to engage the market so aggressively. And what that means is they probably will keep really engaging it higher. And that's going to be a trend reversal signal. If you are an intraday trader, you might want to use breadth or tick. And these are just simply, breadth is the advancers minus decliners. Each index has its own breadth, S&P breadth, NASDAQ, even the 30 stocks in the Dow, not that helpful, but still, it's a concept. Whatever stocks are advancing, minus those declining, that's your breadth. Tick is more, I prefer tick. It is more salient, more reactive, and is updated so much more than breadth, really. It's stocks in an index or S&P in the market ticking up at the last moment minus those ticking down. Volume is participation. So I think volume, we won't really spend time on that. That's just volume. Nothing special about it. If a market rises up on declining internals, that means less participation, less enthusiasm, less buying pressure, and that's a divergence. That's forecasting reversals. If a market goes down and internals go up, that means buyers are hiding. They're secretly stronger than the price would suggest, which that's all we're doing right now. We're trying to figure out what the price is doing, which that's available to all of us. Everybody can see that. What people don't see, what traders don't see, is they take it a step further and look, is the price being confirmed or not? And that's just, again, for more reference for educational purposes, it's Dow theory and it's Wyckoff. It's also market profile. If you studied any of those methods or markets or just educational resources, if you want to learn more, Dalton's work on markets of profile, anything by Richard Wyckoff, especially market profile, Elliott to an example, and Dow theory. So lots of ways you can go well beyond this presentation to learn more. Kind of just jump into this one. Here's the indicator, just theoretical. Again, could be volume, could be 310, could be rate of change, could be tick, could be breadth, etc., and we can see volume here. So I wish I would have blown this chart up, for example, but this is a price going down, lower low, lower high, lower low, lower high. This is a random swing up, but look at this, positive divergence, volume, just kind of squint your eyes there. This is the highest level of volume, at least since October, and momentum, highest level of momentum, and this is going to give us a forecast. When this happens, if you are a random new trader, you would say, oh, I'm going to short this because it's a downtrend. That would be correct. It's the exact thing you should do, is to short sell rallies in a downtrend. However, you're hopefully not a new trader, and so this is going to tell you something that new traders won't have. This little swing up is different than all of these. This swing up should not be shorted. This swing up is potentially the beginning of a new reversal. That's because of the divergence number one, strong burst in momentum, which price is not showing you, strong burst in volume, and we'll see what happens next. It gives, here we go. So here, this is same thing. So new price low, new momentum low, volume up. This is bearish or sell volume. Forecast, the market's going to keep going down. So there it goes. New low, new momentum low, volume, sell volume spiking. That's a confirmation. Market should keep going down. So on and so forth until we get into January. It's going to be the divergence, and prices at a new low, but it swings on up. There's your highest buy volume. There's your highest momentum, and it gives us a forecast. If this yellow stuff aligns and happens in real time, could be a 5-minute chart, could be a monthly chart, could be a daily chart, any market, any symbol, any indicator, or any time frame. This is going to probably be the forecast that the market will pull back, make a higher low, and will eventually go higher. This is the crux of the presentation. This is what we're looking at. It's a singular focus. We use moving averages, but it's the forecast from this, well, the confluence, not just one event, the Martin-Pring model, which is the weight of the evidence. So, all right, now got through that. Any questions so far? Because all the theory's gone. Now it's real charts. So that we made it. Any questions before we jump into the real charts here?
Do you also look at the larger time frames to confirm?
Yes, larger time frames, absolutely. So in my weekly report, I do swing trading on oil and gold and stocks and dollar, not so much a dollar anymore, but and treasuries. I look at those. I trade oil, gold, and S&P ETFs. So if you're looking at the S&P, for example, and you're trading Google, NASDAQ, Apple, whatever, the leading stocks or stocks in certain sectors, you would want to have the higher picture. That's what I do with my reports and trading too. It's a higher frame drills down to lower frame. So let's say, for example, just bear with me, that this is a 5-minute chart. This is a 5-minute chart, and this is a 64 per share, is a major support level on a daily chart. And the market is coming down on a lower time frame toward a higher time frame. Maybe it's a prior low, maybe it's a trend line, whatever it is, maybe it's a range, whatever's happening, that we know that 64 is very significant, very demonstrably a low. So in the lower frame, 30-minute chart, hourly chart, 5-minute chart, whatever, it comes down and forms this pattern. Well, odds already favor the market pushing up away from that just because it's a support level. But when you see a lower time frame and this type of pattern, that's just, oh my goodness, that's just, the odds are falling very strongly. The dominoes are falling in place, the puzzle pieces are fitting together. You have 2 time frames saying the exact same thing. And also, you can align these, and these little kickoffs in a higher frame will work in the lower frame. So if this is it's a daily chart, but if this is happening and it starts to hook up and go from 60, let's say 5 to 676, this might, well, it was half a month. It was about a 2 to 3 week period that this stock, which of course it did, I just pulled the stock up just through the lines. Basically, this little pattern on the daily chart forecast this little upswing, and so you can, on a lower time frame, trade your pullbacks through February into March. You can swing trade it, let it be gone, and let it do its thing, or you can project this up, Apple, Netflix, or ExxonMobil, whatever, Goldman Sachs, whatever stock you're looking at, and play intraday as it rallies, as it should do on the daily, or the pullback here, etc. So before we go on the next section, just kind of a little insider tip, or personal tip. The best trades that I take, I'm a nervous trader. I'm conservative. That's why the site's called Afraid to Trade. My goodness, I like to look for all kinds of evidence to get in my favor. That's why I take a more academic approach, and I have a lower trading frequency because of it, but that's just personal. So if I'm able to get this type of pattern, the market's uptrending, volumes confirming, etc., and we pull back, I'm going to drop to a lower frame, and if I see this little reversal pattern take place on a lower frame, oh my gosh, get me in there. Give me some options. I mean, don't get overconfident with it, but it's just, yeah, 2 time frames, the same picture. You're just creating a narrative, and it's all about supply and demand.
There's a couple more questions. As the price moves, does the volume increase after the divergence?
It should. So price does move. We'll see the examples, but this is, again, kind of, you can see the price. I'm just making sure the concept goes through, but you're seeing volume pick up. And so the main idea, Dow theory, etc., is if price is in an uptrend, you want to see volume coming with it. And so if that's playing out, you would forecast, and trading's all about forecasting, really, or probabilities, that it's confirming, therefore it should keep going. So yes, as the market goes up, there's 2 things you want to see. You may not see it here because it's theoretical, but you'll see it in the real time. But on an upswing, if you're forecasting out, I think the market's going to turn and go higher based on this model, all right? Well, as the market does go higher, you want to see what you did. All that green stuff is green volume. SPY volume is consistent. Market went up through here. So you want to see a buy or green volume trend up or be higher than relative, maybe a 10-day average or something. But on the pullback, the other thing you want to see is you want to see sell volume light. So the most perfect little pattern in terms of volume will be uptrend, strong buy volume during an upswing, and relatively low or like this. See that? If that's, again, this is theoretical, but if that is a downswing, the sell volume went down and the market picked back up. So you do want to see higher volume, rising volume supporting the price, which is supply and demand, on an upswing in an uptrend, but also you want to see weakening. In other words, you don't want to see buyers or sellers aggressive and active and, I wouldn't say raiding the stock or raid the supply and demand or raid the shares, but they're coming in. They're not coming in. Sellers are weak and they're not deploying their full arsenal on a pullback. So just to summarize, uptrend, upswing, higher buy volume, and a pullback in an uptrend, declining sell volume. That forecasts a higher high. But you want to be a buyer of the pullback.
Let's see, there was another one. What do you set the smooth to when using the 310 MACD?
Oh, good question. Yeah, so the standard, I have a custom one, sorry. The standard MACD is going to have a smoothing average that's 12.26.9 or whatever it winds up being in the default. You're going to smooth it out. I don't want to see that. I don't. And in terms of my methods or this concept, I don't want to see the smooth factor. I'm not using it as a MACD. I'm using it as a momentum indicator, and so I'm going to turn it off. So some chart programs, TradeStation, they'll allow you to just eliminate the signal line or the smoothing line, which usually I think is red in most platforms. But you can just take it off, or I think stock charts, I use stock charts. I either put a 1 or a 0. In TradeStation 2, it's either some charting platforms are different. 0 might give you a kind of a divide by 0 error. You can't do that in certain programs. Otherwise, 1 is just, it's not going to show up in your chart. But I don't use that, and so if you can turn it off, that's my preference. I do. And the indicator that I've created, it just turns it off. It's not even there. I just want to see the difference in the 3 and 10 and just what does that mean? That's the difference in a very, very short term, which is a 3-day or 3 5-minute bar or 3 bar. I want to see the difference in that and the 10 bar. And so if the market moves up rapidly, that difference is going to be wide. When it shrinks or the market doesn't move a lot, that's what's going to create these divergences. So yeah, just a quick answer is turn it off or eliminate it from your chart, because there's nothing you'll see in the examples like that. The question was the signal line is going to be that red thing or whatever the color it winds up being. It's going to average it out, so it's going to look like this. It's going to be like da, 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 down through here, and I have no use for that in my
Okay.
trading.
And last one, do you use the zero line in the ROC as a trigger?
Good question. On the rate of change, let me jump back to that one right here. So there are methods, and I'm not saying my method's the only one. So and I as a CMT, believe me, there's so much good stuff and some bad stuff, but a lot of good stuff. If it works, use it. But I don't use the signal. I don't base any, and we'll see it shortly, but I don't base any decision, any trade, any forecast on an indicator. So even this the MACD stuff, it's a higher high kickoff. There's no trade from that. It's a kickoff. It's a fact. This is a divergence. It's a fact. But there is nothing you can do to put a trade on. It's just you're putting a puzzle piece that this market's going down, making lower lows, lower highs, lower lows, but it's positively diverging. That forecast a possible reversal. I'm going to make my decisions based on the price. So breakouts, pullbacks, maybe a moving average. But to me, this little crossover stuff, the zero, same with the MACD really, I have no, again, I'm speaking as Corey, I have no use for it. It's maybe you can buy, and people do this, if it's an uptrend, maybe buy it when it's down here, when it goes to the zero, it crosses over. That is certainly something people can and do indeed engage in. Or when it's in a downtrend, they would sort of push above it, fine. But I would rather manage my trades based on price and to an extent moving averages. So I know it's different, but if you find success with it, do it, which is an uptrend buy indicator pullbacks. Well, I just want to use averages. So to me, the zero crossover, I've done work with that. I've researched it. I've done back testing on it in TradeStation, and I just haven't found that it worked for me. I want to figure, here's the main thing. I want to find supply-demand balance. Who's in control? And I want to engage my trades, engage that side. So, and I'm usually going to do so with price. So that's going to be trend line breakouts, touches and moving averages. I'm not going to determine a sell, buy, short, what's it called, a stop loss, or those things based on an indicator. Other questions?
I think that's it. We can keep going.
Awesome. This is good. I love it. Yeah, I make it interactive. This is cool. It makes it more fun. Okay, so now all that you've survived, if you're still here, you survived. And so now we're going to see it in action, and trust me, it makes a lot more sense when you see it played out on real-world data. So this is the Russell. Well, this is going to go back to, I guess, August here, and 5-minute chart. This is just my time frame. I look at the I set my trades up on the daily chart. I have a thesis and forecast of what I expect on the daily chart, usually key levels, and I'll play it out on the lower frame, usually the 5 and sometimes the 1 if it's a trend day. All right, so the Russell coming up here, kind of a choppy, August 23rd, breakout, gap, new momentum high, new 310 high. All right, that's cool, it's good. Buy the pullback, not really a pullback there. Couple of pullbacks, not really wonderful, just kind of fizzled out. All right, so this is a trend day at the start, fizzled out toward the end. So you could have got a couple of buy trades off of here, but it would have retested the high, but nothing to write back home on. All right, so that essentially failed, and it failed essentially because, well, what factors suggested that? Factor 1, as the market made a new high, 1246, you're seeing the momentum peel away. That's just making a divergence. So accepting this spike, if you kind of look at the closes, even that level, 1246, market's at a new intraday high, momentum's not. So one more time, higher high, higher low, positive EMAs, price at a new high, momentum is peeled off from the earlier session, from the start. Even though price kept going up, the indicator kept going down. Once you get that, the next session for making a forecast for the next day, you would say, I'm going to be cautious against resistance at 1246. There are divergences. I expect the market to peel and go lower, to trade down away from 1246, but the alternate thesis is that the trend continues. We get a breakout first thing in the morning, and I'll actually go long at above 1247.48. However, when you woke up, you had a downside gap. You actually, here's the key, well, the kicker. The key is that the Russell had a kickoff, or the indicator had a kickoff, meaning this is not, this is the lowest low going back to this point. So just to reference, the price is really not that stellar. It's not, if you kind of take off this side of the chart, you can't see the future. All you know is price is kind of at the low. Not that big a deal. But the momentum indicator says, oh yeah, that's a big deal, because there was a divergence persistently and against 1246, and you woke up to a kickoff. This makes you a short seller. If you paint this in terms of new traders, you paint this red, and you want to be a short seller of pullbacks. Took it a while, took it a little while, but your efforts paid off because the market collapsed, traded down, and there's your rounded reversal that was arguably forecast from right off the open in the August 24. And of course down the market went. Other examples. Yeah, it's the same chart. This is the same thing. So is it? No, it's not. Yeah, okay, sorry. This is the 29th. So a couple of trading sessions ahead of where I had this prior example. So this is the 29th of August. There's your, again, just kind of quickly, divergence, kickoff by the pullbacks. Uh-oh, you're having divergences. So similar, on the 29th of August, you're having three new price highs in an uptrend. By the way, these little pullbacks worked. Touch the average, buy the retracement. Minimum target is the prior high. Ideally, you hold till the market breaks a rising trend line. So it's just a flag. In terms of retracements, flags, ABC, break the trend line, touch the average, get into the market because it probably makes a new high, and then exit as it breaks a rising trend line or touches the prior high. That's your retracement rules in a nutshell. So there were two divergences. Price made two higher highs on the 29th. And that's going to forecast your session for a sell day or a bear day against, once again, 1242, which is a higher time frame level. You might not see it here, but it was at the time. So the markets are scraping up against a higher time frame resistance. What does the lower time frame look like? Negative divergences and kickoffs. That tells you something is not good, something is not bullish. It's actually bearish. Your forecast, if you draw out the future, is for down. You want to be a short seller of the retrace here. And what you're seeing, price is kind of pushing down. Momentum is pushing off to new lows. There's a little trick, a little gap up, not a momentum high, and the market fails. So this is a real world example. This is not a textbook, oh, look, Corey, it's perfect. It's not perfect. Market isn't perfect. So what would be perfect if it kind of came up, touched the average, and went down? It didn't. It tricked you. It got you. It's a trick. Then it fell. So trust the method. Trust the supply-demand relationship. Trust that this is telling you that the bears are overpowering buyers. That's the message the market's giving you. You engage it by short selling it, and you look for spots to short sell, typically on pullbacks. And again, your stop's going to be above, because if that's true, the market should not go above the high. And this kind of looks weird, but if you're shorting somewhere here, or shorting this pullback, you may take heat, but you don't take a stop. So anyway, retrace, break, boom, retrace, break, boom, etc., and rinse, wash, repeat, because the market had a rounded reversal and went back up. But the main idea here is your divergence, kick, 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 down. It's your forecast. Looking at the NASDAQ, this is September 12, a few weeks ago here, or I guess a month ago. Up by the pullback, up by the pullback, whoops. Market, this is again the NASDAQ 4760, negative divergence. We're going to now add in our tick, T-I-C-K, that's the number of NYSE stocks, ticking up minus ticking down. So here is your momentum high. Here is your tick high of the session, 11 o'clock Pacific. Buy the pullback, and that the forecast is for the market to go higher. It did. The market makes its highest high at right about the close. Where is momentum? Down. Where is tick? Not at the highs, and it's been downtrending ever since. What's your forecast? If you're writing a report, which is what I do, and you're trading the next session, planning it out, higher time frame, what's your expectation? Down, bear. You're just waiting for a kickoff, and that darn kickoff came in the morning. There it is. Down gap, tries to fill it, fails, and there's your kickoff. New momentum low, new tick low, forecast in real time, a little orange thing I drew for you, retracement up, short sell the retracement, there's your lower low. And of course the same little principle takes place. It's not a trend day all day long because there are divergences. At 10 o'clock Pacific, positive divergence in momentum, positive divergence, that really closely, and it's a 3, 1, 2, 3. And that just says what does that mean? The number of stocks that are ticking down at the moment, at the morning, was strong. Lots of stocks were ticking down here. Fewer stocks were ticking down here. Even fewer stocks were ticking down at 10. That's when the market's at an absolute all-time, this day, intraday low. Let's just fact check this. Market is at a new intraday low of the day, called the LOD low of day. Momentum is saying non-confirmation. Tick is saying triple non-confirmation. We don't want to short sell this. Don't do it because it's essentially a divergence, and then we swing up to a new momentum high, new tick high, and you can see what happened next. This did not trade lower. It reversed, and you would have got some good plays off of that. This is going to be true if it's, again, this is 5-minute for trading tactics, retracement, that's a retracement right here. If you're not a full-time trader, that's fine. You can use maybe an hourly chart, 30-minute chart, do this, the same maneuver. Use it the same with Apple and Google, Netflix, Exxon, Sears, Chipotle, ETFs, gold, silver, the list is endless. You won't have tick on oil and currencies and that kind of stuff. But you will have it on index futures, and you'll have volume for stocks. So do incorporate the principles. I'm an intraday trader, so I look at tick. Tick is very important to me. So is momentum. But tick isn't there for currencies and such. All right, a few more.
Just a question.
Yeah, okay.
Let's see. When price crosses the MA, do you get out or reverse the trade?
If you're in a trade, let's say, if you're holding a core, let's say, for example, that this is not a 5-minute. You can even do that. But if, say, a daily chart and you're swing trading, you'd buy the pullbacks in an uptrend and short the pullbacks in a downtrend. And you would continue that behavior until either factor 1 is your div plus kickoff. When this happened in real time, you have to make a real-time decision. Do I short sell here? The answer is no. And, of course, do I buy this pullback? The answer is no. And so, right, if you do want to hold a core position to last a while, not just kind of be as reactive, and I may trade 4 to 6 times in a trend day session, that may be too much, may not be enough. If you just want to trade a couple times a day or swing trade, yeah, you would use the crossovers as a focal point. Let me see if I can jump back real quick. A focal point for what's called core trading tactics, and that would be this. So essentially, you hold a core short. You put it on, you let the trend go until the trend makes a higher high, higher low, takes it out. It's what we call the T-Rev. T-Rev trade is a trend reversal trade. Call it a core trade, not a core trade, but core trade, etc. And you can just engage that. So sure, put this on, let it go. You can trade the pullbacks or just ignore them, let this thing go as long as it goes until the opposite happens, which is a divergence, trend line break, EMA crossover, and the market flips. So yeah, absolutely, good observation. Yeah.
Can the kickoff signal be automated?
I work with some firms in New York and some different hedge funds up there, and then some really talented programmers. Granted, I'm just one guy, but in terms of college, I've tried, I believe, I've been like, can you please program this and make my day so much easier? And not, to my knowledge, to Corey's knowledge, no, and what they've told me is no. Doesn't mean it can't be, but what they have trouble, people I work with have trouble doing divergences themselves. So it's very difficult to factor in, especially what's called multi. The human eye, you have such an advantage as a trader. You just do, and this is visual. But if this is a computer and it has to determine is this equal to or greater than that, what if it is not? What if this is higher just by a little bit? What if that's lower? That's going to be a false signal. The computer will say not a divergence, but clearly that's a divergence. Clearly that's a divergence. Can it be automated? I would love for it to be, and just not even talking moving average stuff. And I've brought this to programmers, brought this to hedge funds people, but they brought some ideas to me. And in the work that Corey, that I've done, I've not been able to do this. Maybe someone is. If you can do it, great. More power to you. But I've just found that you're trying to pinpoint supply demand. That's the Wyckoff, that's the Elliott, that's Dow, Charles Dow. That's really the founding fathers, all the technical analysis people, and what gets you as a trader success, which is figuring out which side of the market's in control, bulls or bears. And if they're neither in control, it's sideways. No one's in control, you don't do anything. Or maybe you trade fades. But when somebody's in control, buyers, sellers, somebody's not, you want to engage it. So this kickoff, can it be automated? Maybe, but I've not had success with that. So I think your human eye is, and not just to mention that, but is this higher than that? No, but it's clearly higher than this. So how far back? It's a great question. Is this a kickoff by the computer? No. Is it a kickoff to your eye? Yeah.
And then there's another question on how would you manage your stop in one of these trades? Like, how would you trail your stop or manage your stop loss?
Yeah, with clients, I have a more conservative model. I'm more conservative. If you're buying a pullback, if you think this isn't, well, if this is a higher high, strong momentum, you're going to buy the pullback. The minimum should be under the 50, minimum. So in this case, let's see, you had there, because the market on a 5-minute chart should not go above the 50 or beneath it. So that's a good example here. So if you bought this pullback or this pullback here, maybe you got into the 20 and you put your stop under the 50, it kind of just a little nip under it. I would argue first start with the moving average. Use your moving average as your #1 factor because typically price will touch it and rally off of it. Same for the daily chart. #2, if you're more sophisticated, more algorithmic, or more model-based, more objective, use an ATR, average true range. So get in here and factor in 2 ATR, or 1.5 or 2.5. You can test it out yourself. And that might be, in this case, say 5 or 6 or 7 points, whatever it will end up being. An ATR is adaptive. It's an average true range function based on your time frame. So you don't go 1, you go typically 2. 1.5 minimum, 2 more moderate, 2.5 is more aggressive. The wider your stop, the better. I know that sounds really weird, and as a conservative trader, that is weird for me, but I've working with Linda, working with people I've done research with, and just my own research and my own experience for that matter. Wider stops feel really weird. They feel terrible, but they test out better, especially if you get the main idea correct, that this is an uptrend or downtrend, that it's being confirmed, that it should keep going lower. Your stop becomes your enemy, essentially. So yeah, I would argue simplicity, moving average, nothing more simple than that. Then second level order is going to be ATR, and then just the factor is the more the better, wider the better. Maybe use Fibonacci if you're sophisticated. Draw a low to high, and it shouldn't go 38.2 or those kind of things. There's all sort of ways to do it. How do I do it? Moving averages. Other quick questions on the? I love the interactions. It's good.
There's a question on, do you use Rinko charts?
No, and that's maybe my fault. There's a lot of things that have gone on and taken place since I started, and you kind of pick up on a pattern. I learned moving averages first, 310 and trending environments, those kind of things. I stuck with those. Renko charts, case bars, point and figure, things that are cool, percent chart. Yeah, if, or what's it called, Heikin-Ashiki, Ichimoku, etc. If it works for you, do it. And keep in mind what you're trying to do is ascertain the supply-demand balance. So if that works for you, do it. If it compresses time or focuses on swing charts or swing bars or takes away some of these little ranges, that's fine. But just from my Corey method, my experience, no, I'm a candle guy. So what you see is kind of what you get. It's candles. Only thing it's doing different, I use Bollingers. I'm not just for educational purposes, not clarifying the chart, but I'll look at Bollingers, which can also be a stop loss parameter. If it goes beyond that, take a stop. No, I have nothing wrong with them, but I'm just, I hate to say I'm old school because as young as I am, but I'm an old school classic technician. That stuff wasn't around back in Elliott and Dow and Schabaker and Edwards and McGee and Wyckoff. Those are kind of my heroes.
Okay. And do you have any data on your win-loss ratio using these concepts?
Yeah, on my own personal. I typically am in the range now. I divide trades based on performance and based on day structure. If you're just looking at retracements, I typically am 55. I know it's kind of wide range. 55 to 75. It's greater than 50. That's great. I typically do use tighter stops personally. So a tighter stop is going to decrease the win rate. So that's you get more 55, 60. When I'm playing for massive trend days, if it's a major trend day, then I will use wider stops. I feel really weird, but that's when I get closer to 75, which is basically 3 out of 4. But you're focusing on trending environments, confirmation, and I'm really selective. So I don't trade frequently. I'm not trading 20 times a day. I maybe engage 3 to 6, and I focus on trend days. I don't really trade range days much anymore, just in terms of efficiency. So I would say, depending, I do it by month. You can do it depends if there's trend days, that helps more. But typically it's going to go as low as the low 50s and then the mid 70s is my retracement trend day tactics. That's what I typically do. And I'm using ES, by the way.
Okay. All right, I think that's it. We can keep moving forward.
Okay, cool. So a couple more, almost ready. But this kind of just zooms it in. Going to zoom in for you on the NASDAQ 5-min. This is September 6th. Up, pull back, and again, well, with respect to stops, going to trail it under the 50, and you're going to target the prior high or hold it till a trend line comes in and takes it out. So that's how you would play those. And there's a whole other presentation on tactics, but with the main idea for the retracement or the reversal. All right, so uptrend, gap, buy the pullback, wonderful, doing well. Market is still, well, it's downtrending, it's diverging, but as it goes to the next session, September 7, look what happened. So if you're just looking at price, you see I'm excited, and maybe you bought that pullback too, which is fine. You say I am excited, it's an uptrend, higher high, higher low, higher high, higher low, and look at that little pullback to the 50-period moving average. I'm going to just, that's, what is qualitatively different about that to that? And you can't see it, but the answer is divergence plus kickoff. So as the market, we call it stabs. By the way, it's a divergence really closely. I call it a stab. As the market is pulling back and retracing in an uptrend, look at that. 1, 2, 3, 4. 4 big red bars, big ones. And the implication, just looking at that, is that sellers are dominant. Otherwise, they wouldn't have made those candles that big. Sellers were not dominant here because there was more red bars, but anyway, so divergence, price at a higher high, moving average is up, momentum divergence, tick divergence, and that's even from the open there. And what happened on the pullback, which normal people would buy, because it is a pullback. It's an uptrend pullback to the 50-period moving average. Simple as that. It's also a support level. Buy, buy, buy. Where's Jim Cramer? Get in there. Problem is, it's a kickoff down and a divergence down. We don't want to buy these. And by the way, in terms of ratios to accuracy, Don't buy these. You'll have a low win rate if you're buying a kickoff down. Wait for the market to push up. Look at that new momentum high, new tick high, and buy the pullbacks. This is not to be bought. This is a forecast for down action. And eventually it does short the pullback, new tick low, and it forecasts even lower. This was going into today's session. I'm going to have some live charts with you. Well, not live, but just almost live. E-minis going down to 21.20, which was a key pivot, key support level. What's happening? Well, by the way, new momentum low, new tick low, short the pullback. So this right here is a good little short sell. All right, down, down, and not on a tick, but pull back down, retest out the low, good to go, exit. All right, there's your low. Momentum has been forming a positive divergence tick. If you look back to here, it has been. Not an intraday. And I use these red dots to show me what the tick is doing for intraday session highs or lows. That's all it is. So again, a computer would say this is very bearish. A program would say this is not a divergence. The human looks at it and says, but it is. And why is it a divergence? Why is it correctly labeled? Number one, momentum. Number two, tick. Tick was down here the prior session under about -1,000. And at this point, it's about -9. Not that much, but it still is a divergence on the low. All right, so the price pushes up. Look at these green, have an uptrend in the tick. More importantly, the next session, got a good trade off of this one, which was cross, higher high, buy the pullback. If you love Elliott, there's your ABC. Doesn't matter about that. It's just that it pulled back to the 20 average, maybe a prior high there, but just 20 average. Get into the position one of two ways. Way one, aggressive, is touch, called the touch rule. Buy on a pullback to the average, touch it, get in, no questions asked. Simple as that. Stop is under the 50 or maybe an ATR function if you're more advanced. Or if you don't want to do the aggressive maneuver, the maneuver is on the break of the trend line. That's nothing more than a typical flag. That's a pattern. That is a well-documented pattern. Just buy the breakout of the flag. Trend lines, ABC flag, up move, and you're going to retest out the high. What's your target? Retest out the high, and that's what ultimately occurred. And this is kind of a maybe, maybe not. Market crossed. Look really carefully. Look very, very closely at this highlight. And why are we not getting really, really bearish at this point going into the 19th? Answer. Price is making a lower low very gently, but that's a lower low. Lower low, lower high, yeah. Moving average is crossing, yeah. Oops, sorry, jumping ahead here. Moving crossing, yeah, barely. But look, momentum, positive divergence. This is more important. Tick, tick, positive divergence. Everybody see that? Price making new low, tick making divergence, momentum making divergence, followed by a push up. That's a confirmation by the pullback. We got it. Wasn't that much, wasn't stellar, nothing to write home about. It was about 2 points up from there to test out the high. All right, so that's, and this is we're going to zoom in closer. So what you just saw here, taken into today's session for forecasting. So there's your possible trend reversal, but there was not a kickoff. Lower low, lower high, EMA sort of crossed, but not really. Positive momentum divergence on the open and a positive tick divergence. There, it's just a pullback. All this was a little bit steeper pullback and get in on the break or these little touches of your average, retest out the high. Again, about a 2-pointer. That's nothing to sneeze about. But as the market did push up to its new high, which is, this is a new chart high, new intraday high, 2142. Look at your div. Divergence, tick momentum, and kickoff. So red, 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 red. Kind of get I call it a last gasp, last breath of bullish action. Anyway, so what's going to happen going into today's session? In my report, remember, I was saying bearish given these conditions. What happened? Gap down, and here's where the, this is another real world one. This isn't theoretical or textbook. This forecasts a down move. Why? Divergences kick off. New low. EMA's crossed, but dang it, this little thing jumped up and poked you in the eye. One time it popped over those averages. Ugh. This is again what I was talking about. If you got short, if you engaged the market short, somewhere here or wherever, and you put a stop on the 50, you got nailed out right ahead of this. That's the worst thing, is when you get the analysis 100% correct, you get your stop down. Bloody frustrating. But if your stop was wider, meaning the market, if this is true, if what you're seeing in real time is true with this kickoff stuff and the divergence and it should go lower, the market should not make a new high. So if you engage short, your stop should be above the high. Feels weird. It's about a 6-point stop. Oh gosh, that's terrible. But where's your target? Target's the low. So you get a 6 to, it's a 50%, whatever. But this is where tactics come into play. Tight stops, if your idea is correct and if you get the market analysis correct, are your enemy. I know that from plenty of experiences. Tight stops are, they limit your losses. At the end of a month, you'll have lower average dollar losses, and that's just a fact. That's a good thing to have. But you're going to have a reduced win rate. Not a good thing to have. So it's a balancing act, and you have to make the determination. This is a good example. I pulled this out because it's today's session. It's real time. But the market did what the forecast suggested, but it just stabbed you in the eye before it did it. And that's painful. Or you just kind of short the pullback, or whatever the case is. This move here, this reversal, this low, high, low, etc. The main idea, as we conclude the presentation, was that this right here, 11 to 12 Pacific time, this stuff was forecast. Now, not in 100% accuracy by any stretch of the imagination, but given the divergences, given the kickoff, and given the crossover, lower low, lower high, take it out, this stuff was odds strongly favored a down move. Ultimately, you got it, but market had a little trick up its sleeve. So again, real world versus theory. You have real world versus theory. We're not going to play this academic game. It's real world we're trading. All right, so kickoffs are best with divergences. So if you just say a random kickoff, look for divergences. It's the weight of the evidence. There's nothing that's going to tell you kickoff or divergence. It's what's the market doing? Is it laboring to go up? Are the moving average crossing? Form a matrix and form a decision matrix and get the bigger picture from the price itself. Make sure it's confirmed. So a kickoff is not a reason to get long or short, not a trading signal. Let price break averages, break down through it. Let price break some trend lines. Let price determine how you enter a market and manage a stop. And again, just I love Martin Pring. Identify a reversal early, or as early as possible, and then trade with that trend, which is retracements is your best bet, and until the weight of the evidence. That's your divergence. That's your kickoff. That's your high, high, low, low. That's your moving average cross, just to name a few. Don't make it any more complicated than that, although you can. You can add Elliott, you can add Fib, you can add GAN, you can add all kind of stuff, but I'm just making it simple. After kickoff signal is confirmed with price stuff, enter on the first reaction. Let me just tell you what that is. The first reaction is this. This is your kickoff. This is your first reaction. So there's your kick, boom, down, up, reaction. It's basically short selling a new swing in a downtrend. This is not perfect because it's stabbed above your averages, but you ideally want to get short somewhere up into this zone. That's what it means by first reaction. Then once you do that, then trade breakouts, which would be this is a breakdown to short under 2132. Very aggressive, but it would have worked if you get out on the little push above, or retracements, which would be that. And until the counter trend, so it's the people asking about the hold your signal, hold your trade, that's fine. You can actually hold a core trade in the new trend as long as that new trend continues. That's more applicable to swing traders. You can do it on the hourly chart, hold overnight, that kind of stuff, but I don't like that as a trader. As a swing trader, fine. If I'm doing gold and oil, stuff like that, maybe some leading stocks, options on them, fine. Hold that core. And options are good for that necessarily. You can do some little bit more leverage if you're kind of comfortable. 3 or 4 month option outs, whatever you're wind up doing. And they also ask about higher time frames. If you see a higher time frame kickoff or EMA cross or trend reversal and this kind of stuff, they often signal large scale reversals, and you can play them on the lower frame. So project out your movements, lower low, lower high, retrace average, etc., on the higher frame, then play it out on a 30-minute chart, on a daily chart, maybe a 5-minute chart, and that's just building a, at that point you're building a probability grid and keeping it simple. So price doesn't go up like this. You can see this little example. It never goes straight up. It always retraces. So if you see an uptrend, if it's confirmed, buy the pullbacks. And that's kind of a lot of material. And I thank you all for being patient and being enthusiastic with the questions. So I'm here because I like to learn. So if you, and I'm always learning. Markets are always changing. Goodness gracious. So it's 2016 and short to be 2017 and all that. So CoreyAfraidToTrade.com, blog, premium, and a 2-week trial. Let's hit premium and just /Big Mike. But yeah, email me questions, comments, anything that if I can show you indicators, share signals with you, or not signals, but share values. Hey, there's a buy signal in Netflix. The 310 is this, the ROC is that, moving average that. That's I can definitely do that for you. Other questions, Terry?
Okay, yeah, there's a couple here. I'm only going to do a few because we only got a few minutes, but let's see. Are you including the overnight action in futures on your chart when you trade during the day?
No, good question. I work with some clients that's always a sticking point, but it's a conversation point. Jump into the forum, but no, Corey, I'm not going to say I'm the god of the market here, but I do not. So what I'm going to incorporate into what I'm looking at is going to be this. It's a model. It's just where's the model? Yeah. So this even goes beyond that. So what happened pre-market? What happened at the open? What happened the first hour? When I'm making determinations based on moving averages, based on volume, what else? Just specifically moving averages, tick, and not tick, sorry, indicators, Bollinger Bands. I'm not going to incorporate overnight because that's going to skew the chart because not a lot of trades take place. The market's going to extend itself, and you won't see them as clearly. As a personal thing, no. If you want to do it, that's fine. But no, when all the charts that I've shown you, all the methods and how I set up my trading report for members and set up the next day, the sort of prognostications, you won't find overnight. It's going to be this.
And what determines the buy or sell on a pullback? Is it based on the line or a bar formation?
It could be anything. So again, I don't want to be god of the market, but it's just simple a flag. So Charles Bukowski, Shabaker, Edwards, and McGee, and you just look at what a flag is. A flag is a defined trend channel pullback. So you could just base it. You're having a tool. A tool is a flag is a tool like a hammer. So every time a flag takes place, I do this. So your behavioral mechanism or your entry mechanism can just be either a pullback to a trend line, which everything has limitations. In a strong trend, it might not pull back. Maybe it goes under, then goes back. So maybe use Fibonacci. I like to use the trend line break. So it would be, this is a good example. If you sort of draw trend lines with me, then once a market breaks a trend line, it will have already touched the moving average. You can drop to a lower frame maybe, but it's already touched the average. Maybe there are reversal candles, which in this case there are. Maybe buy the high of a reversal candle or buy the flag, just a simple pattern breakout. Your stop's going to be under, I like it, under the 50 moving average, and your target minimum, you can pull off half a contract or half a size if you want, half a position at the prior high, or the forecast is the market goes on to make a higher high. So hold it or hold half or hold all, whatever your contract size is, until it goes up, maybe hits the upper Bollinger. I didn't talk about that, but I do use Bollingers. And starts to pull down. So maybe I like to say the break under a rising trend line, the lower time frame can help you on that, and maybe the break under a 5-minute reversal candle low. So if this is a 5-minute chart, maybe you enter on the pullback, on the break of the trend line, your choice, and you exit on the break of this little steep trend line or the break of that little candle or that candle. So, or maybe you have a target. So There's not going to be one way that you've got to do it this way, but you have to decide, and it's going to be based on your comfortability level, your experience level, and your aggression level. I'm conservative, so I'm going to want the market to do as many things to put as many factors on my side, but that's going to give up trading frequency. I'm going to trade less, and my stop will be a little bit wider, and my target will be just a little bit smaller. So just, if you're more aggressive, if you have a touch rule, touch there, stops tighter, target's wider, it's up to you.
And I'll do this as the final question. Can you go back to the October 20th slide and just kind of summarize the specifics on how you would have traded it today?
Today, let's see, I had the short off of, so I was able to sidestep this, luckily. So I got exited at this, so 2031.75 I think was fine. So I had a target. I honestly did not think it was going to fall that quickly. That sort of surprised me. But I was able to short on the break and go down. I feel I'm not live on TradeStation right now, but 2037 thereabouts, and it was in a lower frame too. So the break back under this, you broke the low and you broke this support level. So I engaged short and just wound up having a much quicker trade than I expected. I wish I would have held longer, but I had a fixed target. Fixed target meaning I had my order resting, and I got hit. Boom. So I was out at the prior low. And the reason how did that happen, why did I get into that? I went into today's session bearish, and in the report I discussed that. There was also I can't show it here, but it was a higher time frame resistance level. This was your daily chart, it's the S&P futures, but it was the underside of the 2050-day moving average on the daily chart. It's about 2050 on the S&P. This is a natural target, this right here. This is a natural spot on the higher frame, so I went into today's session short, basically, I won't say daring the market, but I'm going to engage the market from the sell side. And so that surprised me. I didn't get short because it never touched the moving average. I did a flag trendline break, support break, and target. It was fixed, it was set in motion, and the market just took it out there. So it was a target managed trade. And I didn't show the rest of the day, but that's just showing you how the market reversed.
And just a little, what is the time? Is it Pacific Standard or Eastern on your chart?
Yeah, I'm in Los Angeles, so it's in the Pacific. Yeah, Pacific. I mean, all charts, I think almost all, are 5 minute. I think I showed examples from the Russell, NASDAQ, and ES, but they're all Pacific time. Yeah.
Okay. All right. Thank you for the webinar. Again, great, nice, clean, easy to understand tactics and charts. I like it.
Thank you for having me. I appreciate it. This is fun. I enjoyed this. I like this. Thank you all for attending.
All right. Okay, there it is. Yeah, there's somebody was asking about the trial. So you can go to the premium.afraidtotrade.com/BigMike for a two-week trial.
Or even like CoreyAfraidToTrade.com. Either way.
Okay. And what is the trial of exactly?
Sure. It's the idealized trades, which is going to actually show an example of it, but it is planning out the next day's session. It's two-factor. Factor one is these concepts for the S&P short-term trading. We're going to set up our game plan for the next day. So the same thing. We're going to be bearish up against this pivot because of these reasons and these factors. So tomorrow we expect this to happen. So half of it is planning out the next day. We also have stock scanning, but the first half is a little bit unique. It's different. And I'll see most traders do this. It's self-teaching, self-learning. So whatever trades that you take, whatever trades the market did, day structure, trend day, divergences, I will show the trades, the ideal trades is what we call it, and teach them. So this was the trade. Given this, here's the concept, here's the pullback. It's obviously hindsight looking, but it's educational based, and you can join in whatever your trades were if you had success or didn't work out that day. Go back and look at the ideal and say, oh, that's what I missed. Okay, well, that's a kickoff. I didn't see that. Now I see it. Okay, well, now I'm going to be a better trader in the future. So I call it one half educational, one half forecasting.
Perfect. Thank you for your time, and I look forward to hopefully we can schedule another one soon.
Yeah, absolutely. Would love to. Glad to be back. Thank you for having me.
All right.